afternoon, everyone. Thank you very much for joining our webinar series today. My name is Patrick Ray. I am one of the AT&T focused retirement advisors here with the Retirement Group, and we appreciate your attention this afternoon. Today, we're going to be talking about something very important and a really timely topic for our AT&T folks. But before we get started, there's a few things that I want to share with you. First and foremost, we are not affiliated in any way with AT&T, nor are we affiliated with Fidelity. As it turns out, our experience comes with the thousands of people that we've met with over the years who are in positions similar to yours, and we're helping them prepare and transition into a successful retirement. And one of the many tools that we utilize in an effort to do that is this webinar series. So we have a lot to share with you today, which we'll get started with in just a moment. But in case you haven't seen some of the things we've done in the past, you'll find access to our webinar series that we've done and recorded so that you can peruse those at your own leisure. And there'll be a link in the chat box to get access to those so that you can check those out when you have some free time. And there's also a link in there to get access to our ebooks library, which has a bunch of short to read things that have topics that we get asked to and asked about on a very regular basis. And finally, the last thing, we have something that you'll probably want to take advantage of if you hadn't already done so, which is a complimentary cash flow analysis. And this is a way that we take information and spend some time with you to stress test your overall plans to ensure you're on track to meet your overall goals. And we'll talk to you at the end of the workshop today about how to get in touch with us in the event that you're interested or open to having that done. Lastly, if you have questions about what we have to cover today or any other specific question that you'd like to have addressed, we'll do our very best to answer those at the end of the presentation today during our question and answer session. And you can type those questions into the question and answer box, and we'll do our best to get to those. So without further ado, I'll bring on Mike to talk about today's material. Mike.
Patrick, thank you. And I also want to welcome everybody today. Thank you for joining us. Some great information I want to share with you today. Talking specifically about tax law changes and IRA tax planning, some of our own advice and guidance, and why you might want to consider the Retirement Group and our team of advisors. We've got a significant amount of experience. Patrick and I alone have a combined level of about 55 years of experience in working with AT&T employees. We do have offices nationwide. Patrick and I are based here in the Midwest, but we've got colleagues on the East Coast, the West Coast, and down South. So we probably got somebody near you or in your neighborhood. We have a great deal of knowledge. We understand your 401k and your retirement plan, pretty much all of your benefits, pretty much backwards and forwards. And I just want to touch on, too, the complimentary financial analysis, our Retire Kit. It is a great resource. Please take advantage of it. You can scan this QR code to follow us on our LinkedIn page. All of our updates, we keep that page very, very current, and you could sign up for future webinars, see some of all of our blogs and our newsletters on the website as well as you can always go to our website, theretirementgroup.com. Let's go ahead and jump into today's presentation. First, let's talk about some of the tax changes that have happened over the last few years, the impact on required minimum distributions and stretch IRAs, the age restriction that was eliminated for IRAs, tax brackets, capital gains, and the tax law changes, marginal state income tax rates, and some of the tax law changes which seem to be happening on a regular basis. And I'll touch on some of that as well. First, required minimum distributions. A few years ago, Congress saw fit to raise the age for RMDs from 70 and a half to 72. So individuals with IRA accounts or qualified employer-sponsored plans are now required to take RMDs as they have before, but now they can wait till they're age 72 versus 70 and a half. Now, I have read recently, and I just thought I'd share this with you, Congress is considering, amongst other things, raising the RMD age to potentially up to age 75. They're talking about either doing it gradually or just boosting it all at once. And again, it's not law yet, but they are looking at it. This is a big deal because for many of you, you may not be or want to take distributions from your IRA. You know, the government does want its pound of flesh, and they want you to take these distributions. and pay taxes on them so they can spend them as they see fit. It would be great if they do extend out the age, but as I say, currently, at least it's gone up to age 72. You can take a distribution the year you turn 72, or you can defer it into the next year, but keeping in mind that if you do that, you're going to have to take 2 RMDs that year, which could potentially get expensive. Another major change is in the stretch inherited IRA rules. A spouse used to be able to, a spouse does get to take the IRA and take income from it at any way they want, but the rule changes for non-spousal inherited IRAs, i.e., let's just talk about your children. You used to be able to spread those distributions out over your life expectancy. For example, a 40-year-old could stretch that distribution out again for the rest of their life, which could be up to 45 or 50 years. But the new rules state that you have to take distributions. You basically have to pay out that entire inherited IRA over a 10-year period. You don't have to do it all at once. You can do it all at once. It's probably smart to spread it out over that 10-year period so you minimize your tax liability over that time frame. We talk to clients about this quite often. It's a big deal, and I'm currently working with a couple of clients right now getting these inherited IRAs set up. Preferably, the old rule made more sense for all of us, but they didn't ask our opinion, and these are the new rules with the 10-year inherited IRAs. A nice change here. Age restrictions have been eliminated for traditional IRA contributions. So for those of you who can and do still want to make contributions to an IRA beyond the age of 70 and a half, you can now. You used to be limited at not being able to do that at age of 70 and a half. And there are people out there that are still working and want to put more money away into a traditional IRA. So please keep that in mind as well. Here we're just talking about the current tax laws. Really, we are in one of the lowest income tax rate environments that we have been in a long time. The tax brackets went down. The marginal tax rates, the rates themselves went down. The limits on income went up slightly. So we're going to talk about what I like to call tax bracket planning here in a little bit, but keeping in mind that the income tax brackets for an individual, basically 2 times for a married couple filing jointly. The long-term capital gains tax rates have changed. Congress is looking at changing that again. I'll talk about that here in a minute as well. But long-term capital gains do pay taxes. They are typically at lower rates as long as Congress doesn't take that provision away from us. Marginal state income tax rates. Well, we have clients that work all over the country. Patrick and I are here based in St. Louis. We both obviously live in Missouri. Missouri has a 5.4% marginal state tax rate. There are states that are higher, and that's the darker blue states, many of which are on the east and the west coast. And there are states that have no state income tax rate, like Florida, Wyoming, Nevada, and Texas. Keeping all this in mind, we're always going to pay federal income taxes. There are many states that do not tax pension income. There are some states that do not tax Social Security income. That all depends on the state that you live in. Really, to keep in mind is, where are you going to settle after you retire? Are you going to leave the state that you currently live in, and I'll pick on Illinois, it's got a high state income tax rate, and move to potentially Tennessee or Florida, where there's no income tax on any income that you might have? These are things to keep in mind. And one of the reasons why a number of these states are growing in population is because of the limited or no state income tax on ordinary income. Some of the tax law changes, I'm not going to get in depth here. Just know that there have been several tax law changes. The most recent has been the American Rescue Plan. Congress just recently enacted a small, what they call a climate tax bill, the Inflation Reduction Act. I'm not quite sure how government spending is going to reduce inflation, but they feel that that it will. There have been some pluses, increases in HSA spending limits. That's the healthcare savings accounts, which you all have an option to contribute to, and flexible spending accounts. Just some of the changes that have been enacted and some of the changes that they are considering, all of which usually mean raising tax rates. They're considering raising the top marginal income tax bracket and potentially taxing long-term capital gains as ordinary income. I don't believe that would be a good thing at all. They're also talking about taxing unrealized capital gains at the death of an individual. Right now, individuals do get a step up in the basis of many of their investments at death, and their beneficiaries get that step up in basis, and any growth from that point forward is only taxed at either capital gains or ordinary income. Talk about the net interest income tax rate for pass-through income, what they like to call interest income, just to name a few. But keep in mind, the government is always doing something when it comes to changing the tax laws. Some of them would be good for us. I also read recently where Congress is considering raising both the current contribution limits on 401ks as well as the catch-up provision, which is currently $6,500. They're considering raising it to $10,000. For those of you who like to put as much money as you can aside in your 401k plan, that would be great. Obviously, the current tax help would be awesome as well. Talking about IRA tax planning. First, I want to touch on the interest rate changes and the impact it's going to have on your lump sum currently. We'll talk about what to do with your money at retirement and one of the benefits of what we call a spillover contribution that you can make to your 401k there at AT&T. We'll talk a little bit about withdrawal strategies and special tax situations, and then touch on RMDs again. As I'm sure you at AT&T are all well aware of, the segmented interest rates are going up, and they are up as approximately 2% currently. The rates listed here in the table for June of 2022, 3.64, 4.80, and 4.78, all up significantly from last November's rates. What does that mean? Well, just like the slide says, an approximate 2% rise in these interest rates equals a potential 20%, and I say 20% drop in your lump sum in 2023. Keep in mind, these rates haven't been formalized yet. November is still a few months away, but the segmented rates have gone up every month since the beginning of this year. The Federal Reserve fully intends to continue to raise rates, which will more than likely continue to increase these rates. I could see potentially in 2 or 3 months' time, we may be telling people that the drop in the lump sum could be 25%. It wasn't just a few months ago, we were talking 10 to 15, 20%. This is real. We could certainly help you run pension estimates looking at what your lump sum option would look like for 2022 versus waiting till 2023. It's very important. You want to make sure you understand how this could impact your own retirement benefit, as well as maybe it's time to consider, hey, I might want to leave this year versus next year if your plan dictates. Let us run a retirement cash flow and we'll show you if it does. What do you do with your lump sum? Well, you typically want to take those assets and make a direct transfer or direct rollover into an individual retirement account. Your pension plan and your 401k or corporate plans, an individual retirement account is controlled by you. It's invested the way you want, and there are no taxes on a direct transfer. One of the benefits of what we call the spillover is the limits on pre-tax contributions are $20,500 plus the $6,500 catch-up for a total of, excuse me, $27,000. But you could contribute a lot more to the 401k. It just has to be after tax money. So if you want to contribute, let's just say hypothetically another $10,000 in after-tax contributions, you can within the AT&T 401k. And each year you could take those spillover contributions, because you've already paid taxes on them, and roll those monies over into a Roth IRA. Your traditional IRA is where all of your pre-tax money is going to go. But for those of you, again, who have the ability to save additional dollars, this is something to consider. And this is an option that's available to you at AT&T in your 401k. Talking about withdrawal strategy, this is important. You usually have several buckets of money. One may be taxable, another may be tax deferred, a third might be tax exempt or tax free. How do you maximize the income in retirement while trying to minimize your tax liability? There's good and bad of each one of these. The traditional or the conventional withdrawal strategy would typically state, okay, I'm going to take my taxable income or continued working income, that's first. I've got my Social Security, which is partially taxable, depending on what marginal tax rates you are. And then I'm going to maximize the withdrawals from my tax deferred accounts while letting my tax exempt or my tax-free assets continue to grow. Well, that may make sense for some people. That may not make sense for everybody. But a tax strategy that we like to talk about, and again, I mentioned tax bracket planning, is to maximize each marginal income tax bracket while minimizing overall taxes. And what I mean by that is there's 12, there's 22, there's 24, there's 32, and so on. If you take all of your distributions to supplement your retirement income needs from your tax deferred accounts, that might bump you up a tax bracket, which can get expensive. Now, why not take withdrawals from your tax deferred accounts in the current marginal tax bracket you're in, and then if you need additional income, take that from your tax exempt or tax free assets, like your after-tax investments or your Roth IRAs. We talk to our clients about this all the time. Bracket planning makes a lot of sense. It may make sense for you to take some additional withdrawals from your tax deferred investment accounts in the marginal rate, that the bracket that you're currently in, and then just take those monies and either roll them into a Roth IRA or just into an after-tax investment account for future withdrawals in retirement. Just to summarize, as I say, fill up those lower tax brackets first. Definitely be aware of the taxes on your Social Security benefits. You don't want to pay any more than you have to, and then strategically utilize both the taxable and tax exempt, like Roth assets, to supplement your income needs in retirement. This is a discussion that we certainly can have with you as part of a discussion with the retirement cash flow analysis. Special tax situations. What I want to point out here is there are people that, number one, retire prior to 59 and a half. Oh my God, can I do that? Do I have access to my retirement assets prior to 59 and a half? We retire people all the time that are 53 or 55 or 57 years old from AT&T, and they do want and need an income in retirement. Well, there are a couple of things that I want to point out. One that's not listed on the slide is what we call post-55 tax treatment on withdrawals from your 401k. Simply stated, you can leave all or a portion of your 401k assets at Fidelity after you leave AT&T between the ages of 55 and 59 and a half. You can make withdrawals in any amount from those assets. You do have to pay both federal and state income tax, but you do not pay that 10% penalty. That's just on post-55 tax withdrawals. Once you reach the age of 59 and a half, you might as well roll those assets into your IRA and combine those with where your lump sum went for future distributions. But not everybody's 55. So you got to consider potentially the rule of 72T. This is called the substantial and equal periodic payments rule. And let's just say you're 53 years old. You've taken your pension, you've got your 401k, you roll them all over into an IRA, and there is a special formula that allows you to take distributions, specific distributions from your IRAs, and again, avoid the 10% penalty. There are a number of limitations, and I won't get into all of those now. Just keep in mind, there is an option if you're under 55 to get an income from your IRAs and not pay the 10% penalty. As the slide talks about here, there are a number of other distribution exceptions as well. If you want to talk about any of them, please reach out. We'd be happy to talk to you specifically about what they might be. Required minimum distributions we've touched on. You could take anything you want from your IRAs. It could be as much as you need. It could be nothing, depending on your situation. Just keep in mind that you will have to take RMDs. Either you're currently taking them or at age 72. There is a formula that applies. Essentially, the first year's distribution for an individual that's 72 years of age is approximately 4% of their account balance. Those distributions are calculated annually. It is based on the beginning of year value of all of your combined IRA accounts. Excuse me. So finally, just make sure you have a plan. Again, take advantage of all of the resources that we have to offer here at the Retirement Group. We talk a lot about, planning. People who have planned or are planning are always, for the most part, better prepared for retirement than people who have not done any planning. And I've been doing this a long time, as my partner Patrick has as well. Do a plan, get a plan started now. It's very important. Schedule a meeting with one of us. You could scan this QR code here to schedule a meeting with myself or Patrick, as well as one of our other colleagues if you're in another part of the country. The other QR code, again, will take you to the LinkedIn page. Check it out. We keep our future webinar schedule there as well as it'll take you to the recorded webinars on our website. So with all that said, I want to thank you again for joining us today. We appreciate your time, and I'm going to turn the meeting back over to Patrick for any questions that might have come up. Patrick?
Yeah, thanks, Mike. So yeah, we do have some questions, and of course, we covered a lot of material today, and we'll talk a little bit about some other things besides these questions, because I think I've got a couple of things to add that might be helpful. But first and foremost, the first question: if you're fully retirement eligible and or age and still working, can you claim Social Security and put that money into a Roth IRA or an other qualified source, such as a 401k, and not get hit with taxes?
That's a good question. Obviously everybody's situation is unique, and yes, you can begin to take your Social Security. I certainly wouldn't recommend it if you're still working prior to full retirement. You could certainly take that income and reinvest it into other investment accounts. You cannot put those funds directly into a 401k, but if you're working, you can put income into the 401k as an alternative. You cannot put Social Security distributions into Roth IRAs. You can make a Roth IRA contribution with a portion of those dollars, and those limits are basically $7,000 this year and could be rising. Patrick, you have any other thoughts you'd add?
Yeah, I do. Actually, I've got a couple of examples over the years that I've had people who are fully eligible for their Social Security payment, which for most of you is 67. And they're still on the payroll making a salary at AT&T, which is typically a fairly decent salary in most cases. So if the question is correlated to try to figure out how to avoid taxes, there's really no way to do that, right? Like you had pointed out, Mike. But what you can do is consider replacing your income that's coming from your check at AT&T for the equal amount of your net check from Social Security. And furthermore, making sure that that money goes into the spillover part of your 401k. Yeah. It would be a wonderful time to take advantage of a way to shelter or get money into ultimately a tax-free environment. So Mike had shared that slide with you during the presentation today about how there's a spillover projection or a spillover part of your 401k, which means the money that goes in after taxation is employed. what you do with that money is you're eligible to move those funds directly into a Roth IRA. And you can actually do this while you're working. This is a way typically that we get a ton of people to start relationships with us in an effort to test drive our services, and mostly to establish and start a relationship with an advisory group that they haven't had in the past. And this is a fine way to do it. And so if you're considering trying to figure out how to pay less if no tax on Social Security, that's probably not possible. However, there are ways to advocate the maximum version of what you net from not just an income perspective, but from a future savings perspective. So if you have specific questions about that, we can talk further about your specific circumstance for sure. Here's a good question, Mike. Do Roth conversions make sense when my portfolio is down?
Great question, especially in the environment that we're in right now. First thing I'd ask is if you believe in the investment portfolio that you created, and you don't want to make any changes, you don't believe like you've made a mistake, then yes, it's a great idea when your investments are down, which many of them are this year, to consider doing the Roth conversion. You can convert those assets or more of those assets, which will appreciate when things correct down the road. It certainly does make sense. Everyone's situation is unique, and it all depends on how much you want to do and the impact it's going to have on your marginal tax brackets. It's an individual discussion. We'd look forward to talking to you about that. But in general, yes, it does make sense in a down market.
Yeah, and most custodians, we use Charles Schwab as a custodian if you do business with our firm, allows you to do an in-kind transfer. So if you have money in an IRA and it makes sense to do a Roth conversion based on your tax situation, clearly, Mike had talked a little bit about maximizing your tax brackets. If there's some room for movement and you're eligible to do so, you can move those shares in kind of a given stock with the anticipation that when those stock prices rebound in the future, you get that tax-free growth in that Roth conversion. So it makes a lot of sense to do in an environment where the market is down for sure. All right, last question, Mike. Let's talk about the advantages that we can currently take into consideration with the down markets. So talk a little bit about, the markets being down as far as what, if any, advantages there are in not just investing in the 401k, but outside the plan as well.
Another great question. There's a lot that can be said about this. Again, I'll go back to if you believe in how you've allocated your 401k and your advisor or your own investments, you believe in how you've done that as well. Investing in a down market, it's also a good time to reevaluate positions in your portfolio and getting rid of the ones that you need to get rid of that are just underperforming and replacing those assets with better performing opportunities. All right. I like to joke, I've been doing this a long time, and seldom do you hear from clients when the markets are going up 20% a year. It's when the market's down 20% that you talk to all your clients, and that's what we get paid for. But it's a great time to reevaluate what you're doing. When you're investing in the 401k, about the only thing you can buy today on sale are stocks. And every pay period, you're putting money into the 401k, into the index funds, into stocks that are on sale. It's taking advantage of good investments in a down market makes all the sense in the world, especially if you believe that the market is going to go up again. So opportunities like that are things to consider. Dollar cost averaging is what I just talked about. Again, it's a great time to reevaluate where you are and where you're going. And again, this is all part of the planning process.
Yeah, I'll add to that too while we're getting ready to close up here for the afternoon, that if you hadn't already watched our value webinar that we've recorded, where we talk about taking advantage of the interest rate environment and the negative marketplace, there's two webinars that I could recommend that you should look at or watch if you have the time. One of them is the value presentation that we talk about with our specific strategy at the retirement group, where we believe value-based investments perform unbelievably well in an environment like we're in today for long-term purposes. And the next thing, or the last webinar that you might want to consider watching, is the one that talks about behavioral characteristics and how that provides an overlay to the standard theory of finance, so that when you have an idea of what to do with your investments, you have a plan that's in place that's consistent with your investment goals and your tolerance for risk and your need for income and your financial objectives, et cetera. Because there's a lot to it, right? It's not as simple as just going into the stock market and buying a stock because it's on sale. So I encourage you to watch those two webinars in the event that you have more detailed questions about those two things, and that may steer you in the right direction as well. And then, of course, as Mike had mentioned, you can always reach out to us. You can reach us at 800-900-5867. You can also email us at info@theretirementgroup.com. And until next time, we appreciate your attention. We hope you found some value in spending some time with us today, and we'll see you next time.
Thank you, everybody. Take care.